At the end of the day, making money in the stock market depends entirely on your investment strategy. By now, we have looked at some of the greatest investors of all time and how they were able to generate high returns. And we've also had the opportunity to explore financial statements and discuss why they are important. Now, we're going to tie everything in by looking at one of the most popular ways of investing, value investing. As we talked about with Buffett, value investing involves looking for undervalued stocks whose prices are cheap relative to what they are actually worth. The most important tool a value investor can have is time. If you don't invest time and effort into looking for companies, you won't reap the benefits. Here's Warren Buffett speaking to a group of Columbia Business School students and talking about the importance of investing time to do your research.
Hi, I'm Brian Diefenbacher. I'm a second-year student. Mr. Buffett, it's great to see you again. I was on the trip to Omaha last month. Thank you for hosting us. My question is, how would you recommend an individual investor who follows the Graham and Dodd philosophy to allocate their capital today?
Well, it depends whether they're going to be an active investor. Graham distinguished between the defensive and the enterprising investor. If you're going to spend a lot of time on investment, I just advise looking at as many things as possible, and you will find some bargains. And when you find them, you have to act. It hasn't changed at all since I was here in 1951, and it won't change the rest of my life. So you start turning pages. When I got out of school, I turned every page in Moody's, 10,000 some pages twice, looking for companies. And you have to find them yourself. The world isn't going to tell you about great deals. You have to find them yourself, and that takes a fair amount of time. So if you're not going to do that, if you're just going to be a passive investor, then I just advise an index fund bought consistently over a long period of time. The one thing I will tell you is that the worst investment you can have is cash. Everybody's talking about cash being king and all that sort of thing, but most of you don't look like you're overburdened with cash anyway. So, but cash is going to become worth less over time, but good businesses are going to become worth more over time, and you don't want to pay too much for them, so you have to have some discipline about what you pay. But the thing to do is find a good business and stick with it.
Does that mean you think that we are through the roughest times? You'd always kept a cash hoard around too.
Well, we always keep enough cash around so I feel very comfortable and don't worry about sleeping at night. But it's not because I like cash as an investment. Cash is a bad investment over time. But you always want to have enough so that nobody else can determine your future, essentially. The financial panic is behind us. The economic spillout, which came to some extent from that financial panic, it's still with us. It will end. I don't know whether it'll end tomorrow or next week or next month or maybe a year, but it won't go on forever. And to sit around and try and pick the bottom, people were trying to do that last March, and the bottom hadn't come in unemployment, the bottom hadn't come in business, but the bottom had come in stocks. So don't pass up something that's attractive today because you hope you're going to find something way more attractive tomorrow.
Let's recap what Buffett and other value investors look for. The first trait is that the company should be simple and easy to understand. We've talked about this many times, but it's something you can't forget if you plan on doing well. A good example of this is that Warren Buffett himself actually missed out on the tech bubble of 2000, as he didn't understand what most of those companies were doing. As you probably know, by 2001, most of those tech companies lost over 70% of their share prices, while others even went bankrupt. The second trait is that you should look for companies with a strong brand image. Businesses like Coca-Cola or McDonald's are known across the world and have a stable customer base. These are the types of companies that are deemed safer than the average and that can present tremendous value. Next is to look at earnings. Again, Coke and McDonald's have seen increasing earnings over a long period of time, which is what fueled their stock prices to move higher. Last but not least is management. The reason why management is so important is that whoever leads the company also determines how it will perform financially. A good CEO can make a business prosper during an entire lifetime and can even rescue a company during tougher times. Just remember, when you invest in a business, you're also investing in the management team. Alright, so how do you determine whether a company is overvalued or undervalued? There are two main ways to do this, either by relative or absolute valuation. For the purposes of this video, we will focus on relative valuation. Basically, relative value involves comparing a company to its competitors in the same industry, and we do this using ratios. There are many metrics you can apply, but one of the most important ones is the price to earnings ratio, or PE ratio. You get the figure by dividing price by earnings. The rule of thumb is that the higher the PE ratio compared to the competitors in the industry, the more overvalued the stock is, while the lower the ratio, the more undervalued it is. Let's say Apple is trading at a PE of 20, which we can get by dividing the stock price of 200 by the earnings of $10 per share. On its own, we can't really understand its value, but if we compare it to Microsoft, whose PE is 25, we can determine that Apple is undervalued relative to its peer. Another important metric is the price to book ratio. In general, book value is a rough estimate of how much a company is worth. The abbreviation for this is PB and is calculated by dividing price over book value. If Apple's PB is 14 and Microsoft's is 16, Apple is undervalued in terms of book value relative to Microsoft. Finally, the last crucial metric that I like to look at is the debt to equity ratio. As we saw from some of the legendary investors, they warn against investing in companies that carry too much debt, so businesses that have taken out lots of loans. The debt to equity ratio looks at the amount of debt in relation to a company's shareholders' equity, which, if you remember, is calculated by subtracting liabilities from assets, and is the net worth of a company. The lower the ratio, the better. If Apple has a debt to equity ratio of 0.31 and Microsoft is at 0.33, then Apple is more attractive as it carries less debt. Now, let's look at another way of figuring out value. This one's a little bit more tricky and can be incredibly complex, so I'll simplify it as much as possible. Remember how we talked about the intrinsic value of a stock? If you don't remember, the intrinsic value is the true value of a stock, and value investors try to buy when the current market price is below the intrinsic price. Right now, we'll try to figure out a form of intrinsic price for Apple using random numbers. Let's say Apple sells 100 million products per year at an average price of $1,000 each, making $100 billion in sales. To make those 100 million products, they have to spend $800, which are the costs. This means they are personally making $200 per device, so $20 billion. Obviously, Apple is a business, and businesses want to grow. Let's say that Apple sells 5% additional product each year at the price of $1,000. So next year they make $22 billion, and the year after that they make $24.2 billion. For the next 39 to 40 years, we predict they will make $337.5 billion, which we get by adding up all those figures. If you divide that by the total number of shares, we get a value of $55 per share. That is the intrinsic price. If we were to say the current market price is $40, that represents upside of 37.5%. This means that Apple is undervalued. As you can see, the most important factor for a business is growth, and growth in earnings. If a business can consistently grow its profits, higher stock prices will follow. That's pretty much it for value investing. If you're just starting out, I advise you focus on relative valuation and figuring out how a company compares to competitors in the industry. It's not only an easy way of valuing a business, but it can give you a very precise indication of what investors are willing to pay for peers in the industry. Absolute valuation and figuring out an intrinsic price is also very useful, but at the same time much more complex, and requires you to forecast free cash flow and determine things like the weighted average cost of capital. These are things that you will learn with time and as you look at more companies. In the end, as Warren Buffett himself said, only by investing time in your research will you be able to do well as an investor.